Hello and welcome to SwitzerTV. I'm Peter Switzer, and this is our budget special where I ask my experts what stocks will do well because of the budget and which ones will really struggle. Helping me find the budget winners and losers is Adam Dawes of Shaw & Partners, Rudy Philippek Van Dyke, the founder of FN Arena, Paul Ricardo of the Switzer Report, and Julia Lee of Berman Invest, who will also give us her latest take on Mesoblast that really copped it when the FDA said no to their very, very innovative product. So let's kick off and go to Julia Lee.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, this is our budget special. I'm going to ask Julia what she likes as a consequence of the budget. But before we start, everybody wants me to ask her about Mesoblast. And even those nasty short sellers are short selling Mesoblast. So Julia, how do we play it?
Pete, I guess it was really disappointing seeing that Mesoblast didn't get approval for Ryoncil in acute graft versus host in pediatric use. So I guess looking from here, we've seen a big share price fall, and for our portfolio, we sort of started on a very difficult note in October with that huge fall of about 40% in Mesoblast's shares. We did buy at lower prices though, and so our portfolio is actually trading higher for the month. But looking at Mesoblast, I guess it does look like now that possibly Ryoncil in acute graft versus host might not be the first product off the ranks in the US. And I think there's a possibility that using their product in ARDS for COVID-19 could be the first product off the ranks over in the US. So watching that very closely. Look, outside of graft versus host, there's a number of other catalysts in this particular quarter that we are watching. First of all is the use of their product in COVID-19, and we are due for a second point interim analysis. At that point, what could happen is that the FDA could recommend that the trial continue to a third point, or if the data is overwhelmingly positive, they could stop it there and allow the use of the product in the US for COVID-19 and ARDS. And also, in addition to that, we're still expecting to see the phase 3 results from both lower back pain as well as the chronic heart failure. So lots of data points to be watching there, but unfortunately some bad news in terms of that pediatric acute graft versus host. And it looks like the FDA mainly want to see a randomized trial there. So Mesoblast has gone back to the FDA to ask for another meeting, which is expected in 30 days. So best case scenario is that they see conditional approval with another randomized trial while the product is being sold. And the worst case scenario is a whole new randomized trial, because the last phase 3 actually took 3 years from 2016 to 2019. So that would be the worst case scenario for this particular use, but plenty of other catalysts there as well. But I guess it is disappointing. I do think that we will see the product in the US. It's already being sold in Japan under the Temcell brand. It's just a case of when.
So Julia, so if someone, let's imagine, say someone bought it at $4 and they were really happy when it was higher, and now it's dropped down to $3.30 or something like that. Is it for that sort of person, is it like a let's hold it and wait for some good news to eventually filter in, and sometimes there'll be anticipation of good news, and therefore the share price could rise in advance of any decision like it did before the last one?
Look, this is a company where we have seen share price moves of 30% or more on the upside as well as the downside. So it is a pretty binary decision when it comes to an FDA decision. And unfortunately, it was a binary negative decision in this case. I guess if you're looking to hold shares at this point, it depends on whether you think some of the other products may get up and running sooner. In terms of things like back pain and chronic heart failure, it's a massive market, but it's not something that Mesoblast would probably take on themselves. In those instances, the catalyst, I think, would be finding a partner which would plug in money, and Mesoblast would gain a royalty from those payments, which would be a positive for Mesoblast. So looking at those particular catalysts is what you're looking at the moment. And I think acute graft versus host, you'd have to attribute a lower value to it at the present time, given that you don't know when it's going to come onto market.
So are you a seller or a holder?
So we have trimmed down a bit of our position, only because the core of our investment strategy is looking for company with improving outlooks. And so unfortunately, this means that Mesoblast, in terms of risk management, we have trimmed down, but we are still a holder of Mesoblast. But some of our other shares have been powering along really well as well. So we have entered into a few new positions as well, which have been performing well. So our BlueScope, ALS, as well as Linus have been performing well for us as well.
And I noticed last week EML Payments had a bit of a run.
We are seeing some money coming back into the market. I mean, last week it was the best weekly performance that we've seen for the Aussie share market since April. The market gained more than 5% for the week. And look, it's pretty rare we see performances like that, but it shows you that it's very much a risk on. And Pete, we've spoken a few times before that when money comes into the economy, usually that defines an uptick in the business cycle. And as money comes out, it's usually a downtick in terms of the business cycle. Well, that budget announcement was certainly a boost for the economy, and it's money coming into the economy, which means I think that the business cycle will be well supported over the next 4 years. So it has been a risk on type of market, and that means some of those smaller mid-cap companies have been running hard, like EML Payments, and that they've been doing well.
And correct me if I'm wrong, but I think even a couple of weeks ago you were starting to say that the banks even look like good value, and they certainly, I think Westpac was up 10% last week.
Yeah, when I look at the banks, they're a reflection of the economy. So the fact that we are getting such big stimulus coming through means that, you know, the lower point in terms of this economic cycle is probably not going to be as bad as forecast. Not only that, if we do see jobs being created and jobs well supported, and we know that there is a subsidy of up to $200 a week for employing someone who was unemployed between the ages of 16 to 35, well, that's going to really stimulate economic activity. So they may take out loans either to buy a property or perhaps even a car. And so that's good news for the bank, in addition to the relaxing of the responsible lending laws. There's still some negatives there, still watching to see if there are distressed mortgage holders out there. But the latest update from Commonwealth Bank suggests that that is improving quite rapidly. So the bank's having a good day today, good day last week. And look, at the end of the day, the banks are a reflection of the business cycle as well as the economy.
One last one then. What is the one stock that you really like as a consequence of the budget?
It's got to be
Give me more.
So looking at jobs, so the job subsidies, I think will lead to more job advertisements. And of course, the biggest online job advertisement portal is Seek in Australia. More than 80% of online time is spent on Seek. So look, I think Seek's going to be a big beneficiary. Not only that, they have Xiaopin, so 61% stake in Xiaopin over in China, which is a big jobs website over there. And there has been speculation that Alibaba could be interested in buying into that. So if we saw that come through, depending on the price, that would be a crystallization in value. So liking Seek because of the job story, but otherwise, having a look at some of the other stocks that have been gaining after the budget, we've seen CIMIC, Downer EDI from the infrastructure spend. We've seen ARB as well as AP Eagers from, I guess, the business incentives, the write-offs. You'd expect more four-wheel drives and utes and trucks to be bought, and all those stocks have been performing well. So SEEK's up 7.5% since the budget announcement. AP Eagers, which is basically selling cars and trucks, up by about 10%. ARB's up by about 10%, and we've also seen Downer EDI gaining about 5%.
Julia Lee, thanks for joining us. Talk to you next week. Well, it's another week for the stock market, and it's been a pretty good one since the budget. And joining me is Adam Dawes from Shaw and Partners. Thanks for coming on the program, mate.
Yes, thank you. Good to be here again.
Adam, were you expecting such a good reaction to the budget?
I don't know if I was expecting such a good reaction. However, the ink is all dried now. We know exactly what's going to happen within this budget. And look, there's certainly some very good winners and some losers in this space at the moment. But certainly the winners have certainly done very, very well. Infrastructure's been one of those winners.
And the banks as well.
Banks as well, reduction of the credit restrictions, and potentially then mortgage rates has also surged about 12.6% over the last sort of month. And in fact, over the last 3 months, surged about 30%. So that's really helping that banking sector start to get a little bit of a lift at the moment.
It kind of also implies that if it wasn't for Victoria, you know, the housing sector, you'd have some optimistic feelings about the housing sector in 2021.
Yeah, you're right. I mean, Victoria's certainly been the laggard that we're sort of seeing, and potentially looking for a resurgence in that Victorian market to sort of kick going. But yeah, look, you know, the spring sale is on now at the moment with the real estate agents here in New South Wales, and the auction clearance rates aren't looking too bad either. So, you know, I think that's a real positive for the banks, to be honest. The banks are certainly going to do well in this environment, and potentially if there's more earnings coming down the line, that can be only good for the banks at the moment. So yeah, pretty happy with what's going on.
Adam, what companies are standout winners, and then we'll look at the standout losers.
Yeah, the standout winners at the moment have certainly been the tech space. The tech space and certainly the discretionary spend, or the fintech space, with that potential tax rebate that's been backdated since July. They will certainly see an uplift in discretionary spend. We're certainly seeing also the gas producers. You know, the government's turned around and said that they're going to want more and more gas, and the Beetaloo Basins is one that they're going to potentially open up. So something like an APA will do very, very well out of that transmission of gas in their pipelines. And then certainly the road infrastructure, Transurban, is a natural beneficiary of all that's been going on with that as well. So that's probably one of the biggest spend, is that road infrastructure. Yeah. So there's a couple of winners in that space at the moment.
So Transurban is often seen to be, you know, priced to perfection. Is there reasonable upside with Transurban?
Well, you just talked about Victoria potentially coming back online, and I think that's certainly where, you know, you might start to see some resurgence in Transurban. They've got a fair few toll roads down in Victoria that haven't really been firing at 100%. So once that natural uplift, when people potentially start travelling again, I think there's a natural uplift there for Victorians and for Transurban as well. So yeah, there is potentially some upside there.
Now, why do you think the tech stocks, you did actually touch on it, and maybe a lot of the people watching it might not understand. Are you suggesting that the loss carryback option will help a lot of those sort of tech companies?
Yeah, so I mean, look, the government and their potential, or their tax cuts, which have been sort of brought back to July, that's going to put an extra little bit in everybody's pocket. Potentially that's a consumer discretionary story, and that consumer discretionary story, like the likes of Afterpay or Zip, potentially might do well, or will do well on the back of that. The tech side of things is that basically we've got a fantastic fintech sector that's definitely moving on, and you know, confidence starts meaning more earnings, and when more earnings start coming through, that's certainly where you know, these businesses will do well. So you know, it's the small to medium enterprise businesses also that are going to get a little bit of a boost out of this budget, and I think that's certainly going to do well for some of the fintech stocks that we have in our market.
Away from the well-known ones, is there a sneaky one that you actually quite like, and you thought maybe the budget will even help them?
Yeah, so Wiser is an interesting one. It's sort of been in a bit of a trading range of sort of 18 cents to 22 to 26 cents. That one is a little bit of a sleeper at the moment, and I think that one will do quite well. They are obviously a neobank or a fintech space, and that neobank, obviously they're able to lend to customers. And certainly then if the lending restrictions or those kind of things in personal loans, as well as, these other kind of credit card debts and things like that, I think Wiser is one of those little sleepers. WZR is the stock code on that one.
Okay, let's go to the losers now. The companies that have copped it because of the budget.
Well, usually every budget we start to see something in the aged care space, and we've had a Royal Commission on the aged care space. So I don't know if they're losers, but they certainly got a little bit left out, I thought, the aged care space, and potentially some more funding coming to that sector. So that's certainly something that I'd be careful of, or be mindful of, is the aged care sector and sort of watching that. And I think really then the healthcare sector as a whole, I didn't really see too much in that budget to sort of help with that with that healthcare sector.
Okay.
So again, the likes of Ramsay Healthcare and those kinds of things, I didn't see too much there. Remember, this budget is moving from a hand-holding budget to a growth budget, or let's try and keep the economy moving we've got to move into the growth phase. And I think that's where the fintechs or the consumer discretionary, all those kinds of things, that budget is basically reflecting that attitude.
I'll ask you a question without notice, and you always say I don't know the answer to it, but
I always love those ones, Pete.
I was just thinking, is there a travel company that really makes most of its money within Australia, and therefore when the borders eventually open up, they'll be the first to start benefiting?
Yeah, I mean, Sydney Airports is not really a travel company, it's an infrastructure company, but certainly domestic travel is one of their, not one of their biggest, but certainly that's an area that will definitely benefit from that Sydney Airport. And really, I guess, probably Flight Centre. They've obviously trying to concentrate on package holidays to Fiji and whatnot. I think they'll turn their focus more to, going up to Newcastle or going down to St Kilda Beach or something like that. And they might do some more packages there. The stock's at $14 at the moment. I mean, it's had a good run from $9, sort of $10, and sort of kicked up a little bit, and holding that $14 level at the moment. That's probably something that sort of local tourism, once it opens up, I think is definitely a benefit.
Okay. Well, while I've got you on the spot, let's imagine, one of your dear little children said to you, Daddy, Flight Centre in 2 years' time, when the whole world goes back to being normal again, will its share price go anywhere near where it used to be before this terrible pandemic came along? What would Daddy say?
I don't think $50 is on the cards at any stretch of the imagination. I think Flight Centre is one of those ones that they look to do a lot of corporate travel, or they started to move into that corporate travel space before COVID. And I think that might be the sort of their saving grace, because corporates will start to travel again. I know there's a lot of managing directors that got itchy feet. They're keen to get out and see the offices. They're keen to sort of press the flesh. Will it get back to $50? No. You probably get $20, $25 as a sort of first port of call, and then really, it's good. They've just got to make the numbers, and they've just got to get it moving. And they've done a huge cost reduction cost out program at the moment. That's going to take a couple of years to come through. So it's just going to take some time.
I might get Screw Turner on the program. He might know a little bit more about Flight Centre than you, Adam. Do you think that's possible?
Maybe he might. Maybe he might.
Okay. One last one. How do you play Mesoblast? When we found out that the creeps at the FDA said no tick for you, and it fell to about 340 or so, I thought it's about time I bought Mesoblast, so I did. But how long do you reckon I'm going to have to wait? 6 months or 12 months before I get a bit of pleasure?
Look, I'll probably go for the longer period, maybe 12 months. I mean, they're going to have to go back to FDA. The FDA said, look, you need more testing. It didn't meet the endpoint. You need to help. You need to get some more testing done. And that's the problem with these biotechs. It's either a binary outcome, yes or no. The answer was no. FDA is very political as well. So I'm always cautious about the possibility of this not going through as potentially as what we thought. I'm really the way to play Mesoblast now is to wait. You need to get some confirmation of sort of timelines. From there, you would then start to plan your entry and exit points around those timelines for another FDA approval. but I think this is the third time, correct me if I'm wrong, Peter, this is the third time that they've gone to FDA and it's been now rejected. So I'd be cautious about Mesoblast going forward. I think they're going to struggle to get this across the line. And I'm very nervous on this FDA or the potential of this next FDA approval.
Well, on that really positive note, we'll say thanks very much for joining us, Adam Dawes.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, joining me now is a good mate of mine, Rudy Philippek van Dyke, the founder of FN Arena. And I wanted to talk to Rudy about what he thought the budget might do to various companies. Is there a buying opportunity because of the budget, or maybe there are stocks that aren't going to do all that well because of the budget? That would be a bit of a surprise, but Rudy's known for surprising me. Rudy, thanks for joining us.
I believe my other name is Smart Alec.
Yes, exactly right. Now, tell me, mate, the budget in general, what do you think it's going to do to the stock market?
I think it basically already has done that to the stock market. If everyone who had been paying attention would have noticed, the stock market looked quite weak for 2 or 3 weeks, and then all of a sudden it had its best week, I believe, since April. And that basically you can relate that back to the budget from Canberra. Having said so, as you know, I'm an avid reader of quite a lot of commentary and responses that come around. On my observation, most economists believe that it's not enough. So that's not necessarily bad news. It just means that we should expect more to come in 2021 next year.
Yeah, and I guess in many ways, the budget has turned a fiscal cliff into a series of steps, but those steps might be too big, and Josh might have to put a few bit of new steps in between the big steps to make sure the economy doesn't tumble over in 2021.
Yeah, absolutely, and that's why I think the investors should, at this stage, simply anticipate that the government will do more. Yeah. If and when needed, and when it will be needed probably. So they're basically hoping they don't have to, but it's probably that's probably too optimistic. Yeah. And we should have both the Reserve Bank as well, the RBA as well, continuing to accommodate the economy, and the government jump in this time as well.
Okay.
Yes.
Rudy, Westpac was up about 10% last week. Is that a part related to the government's hope that they'll get rid of responsible lending?
It's a combination of all of the above, but we haven't had the above yet. But people will know what I'm referring to. I think the banks would be the main beneficiaries here. There's 2 reasons for that. One is bank share prices were relatively cheaply priced. Everyone knew that. I mean, everyone who follows the sector was saying that they look cheap, but there's no catalyst around. And there's still a lot of risk. I think under the broad banner of what is good for Australia is good for the banks. And in that sense, the bank share prices have lifted. And I think from that perspective, it's easy to see how the banks have been and will be the main beneficiaries of the budget.
Yeah. Rudy, I interviewed Mark Burris recently, and Mark has a bit of a handle on what goes on in the finance and business and the banking sector for obvious reason, because Wizard and Val are big players in that section. And I said to him, do the big banks, are they really threatened by the fintech banks? And he kind of said, well, when you think about it, CBA is probably the biggest fintech bank in the country anyway. He doesn't seem to think that the fintechs will eat too much of the big banks' lunch. What do you think?
I think they will eat some of it, but we shouldn't underestimate that how large the banks are as in terms of size. I mean, I think the fintechs will start hurting them, but they won't destroy them. I mean, they're not big enough for that by far. I do think what the fintechs will and are exposing is that the banks, with exception to a certain extent of Commonwealth Bank, but all the other banks have been under-investing in their technical capabilities and systems, and that unfortunately they will be forced to change that, and that is one of the reasons why the outlook for banks will be a lot more subdued than in the past, because all the billions of dollars they haven't spent in the past, they will have to spend in the future.
Yeah, but I guess I think also, well, a bank like Bendigo or Bank of Queensland, both banks need a bit of help. They could go out and buy a fintech bank, and there's no legislation stopping them.
That's true. That's true, and it's more than likely that there will be at least one more bank merger in Australia, and that is because the banks you just mentioned, and you can throw in AMP, who has a bank, and you can throw in Suncorp, who has a bank. That they will all be looking in and asking the question, what's the best way forward for their banking operations as well.
Now, when you and I were much younger, maybe 4 or 5 years younger,
last year,
you would remember a budget where one company in particular was completely chaosed by the government decision. Do you want me to see if you remember, or is your knowledge of the English literature so good you can never forget the name of that company?
I don't know. Is it Telstar?
Rudy, you remember Macmillan's Shakespeare?
Oh yeah, absolutely. Oh, absolutely.
Yeah,
absolutely.
The treasurer changed the rules around car leasing, and boy, that share price copped it. I think the treasurer backed off in the end, didn't he?
But that was really bad policy. That was policy announcement without consulting and without any warnings in advance.
That's right. Yeah.
We haven't seen that very often.
No, we haven't. But is there a company that you think is going to do really well or do very badly because of the budget, banks aside?
I'm not so sure whether there's too badly around. I do think that the government is still not doing enough for the aged care sector, but they're probably going to wait until that report comes out next year from the Royal Commission. Yeah. But they will have to top up that one as well. And basically, that sector really needs to be restructured. From the ones that are doing well, I think in the slipstream of the banks, you will have companies that are involved with mortgages, companies that are involved with construction and building materials. And if you take it broader, if Australia is having a little bit of a bounce in its step economically wise, and the US will have to increase their stimulus as well, we will probably see a stronger Aussie dollar, and that will benefit companies who are more domestically focused, and that might yet be another benefit for retailers as well, because they import most of what they sell. Yeah. I don't think those themes change the underlying trends for, let's say, the likes of Aristocrat Leisure, CSLs, the Pepcors, etc. But at the margin, they can make in the next 6 months or so, they can make quite a difference, just for the time being.
Okay. Now I'm not going to let you give the answer CSL, all right? But what is
CSL? Oh, sorry.
So if you look at the budget, what is the one company that you think really looks good, or maybe one that lately has been belted up that looks like good value? A2 Milks, for example, is one that's been belted up. Is there a company that really is on your radar screen, either because of the budget or not, that really looks like a screaming good buy?
Yeah. It obviously changes every day. Yesterday, I could have safely said Bapcor, which I've mentioned a couple of times here. But this morning, they updated the market and the share price is again rallying today. Another company that we've highlighted at FNRINA recently was Downer EDI. If the infrastructure spending comes through, Downer EDI is one of the major players in building roads in Australia. And the share price, even though it has it's on an uptrend, it's still nowhere near to where analysts think this can go. So those are a few names definitely to pay attention to. I mean, I previously mentioned Aristocrat Leisure. I think if economies open up and everyone starts going to the casinos again, that would be a major beneficiary as well. And I still like the likes of MCOR, for example. I think there's still a lot of potential, even though the share price has gone up recently. And keep your eyes out for the results of Technology One, which are upcoming, and which, without losing the court case, would have come out above management's guidance. So underlying, that's a very strong result again.
So one last one before we go, because I do remember a time when this stock was in your, I think it was in your all-weather stock, and it was one that we should be certain about, because budgets bring taxes and life brings death. InvoCare used to be one of your favourite stocks. What's going on there?
True. What's
going on there now, Rudy? Is it in buying territory again, or does it have some fundamental problems?
No, I think there's some fundamental problems there. I think the weaknesses in the InvoCare business model, unfortunately, have risen to the surface. I mean, they failed their expansion in the US. They are now being to a disadvantage because we can't have too many people crowding around at funerals. There's probably also a little bit of disruption going on as well. People maybe don't want to pay the full price now for a funeral. There's at least one smaller competitor listed who offers some competition when they want to buy some assets in rural areas. And in general terms, I hate to say this, but the more I have found out about how that industry operates, it's a little bit like aged care. The least I came to like it, and I wouldn't, at this point in time, I would not go into that sector at all.
All right, mate. Always good to talk to you. Before we go, just so we can remember you with one company name, which I can either praise you for or gently criticise you for, what's the company people should look out for?
The one that people should be looking out for. See, I'm still an enormously big fan of Xero, and I know that the share price has gone up a lot now. It's $114. People were calling it extremely expensive at 80. I still think there is a very, very long runway of growth attached to that company. And I mentioned earlier Technology One. Well, Xero is about to release their financial results as well. And I'm certain we would just have to keep a good eye on that one. And I would say, if there's any weakness that follows the policy release, I think investors should be looking into adding some. Okay,
now one last one to follow the other last one. I remember a time, as I listened to you, Rudy, memories come back. A company that you did once like was Nearmap, and it did well for you at the time. How's it doing now? What's its outlook?
The outlook is more sketchy now. They had to scale back their expansion plans. They sort of are close to being profitable, but the heat is on in that sector. There's definitely more competition opening up. I think you could buy some Nearmap as a punt, but the risks are there, and the positive outcome is not guaranteed. So I do think, given where the share price is, it doesn't look extremely expensive here, but the risks are definitely attached to that business model, and they're officially not profitable yet. And so you have to. I mean, let me put it this way: there are less risky propositions around, and it is, in the end of the day, it is a relatively small company still.
Yeah. So I think I'm going to link you to Aristocrat Leisure once we all get back to normal. How's that sound?
Yes, that sounds like a great idea.
Rudy Philpeck van Dijk, founder of FN Arena. Thanks for joining us. Well, I'm catching up with my colleague Paul Rickard from the Switzer Report. I'm going to put him on the spot and ask him for a company he liked out of the budget, But also, I want to talk to him about a story he wrote about short selling. And this should be an interesting one. Paul, thanks for joining us.
Thanks, Peter.
What's the one stock out of the budget that you either want to dump or buy?
Well, the one I wanted to buy was JB Hi-Fi. It did rise about $4 post the budget, so you may have missed the best there. I think stocks like IOOF is still in big trouble. There are big changes in superannuation that got a little bit of publicity, but some of the pressures the government here is going to apply to the wealth managers about reporting of fees and making sure their funds are competitive and potentially stopping new members opening an account if the fund's an underperformer.
Right.
That's going to have a big impact on the wealth industry, so I think it's going to be a little bit harder in that space. So
you dump IFL?
Well, I think IOOF is struggling with its acquisition, and I still don't think it's a buy, Peter, so it's probably the one I would now sell. I would have said Link, but there's been a takeover offer for Link today, so I would have looked pretty silly.
But takeover offers can actually make you look silly at times, can't they? All right, but this won't make you look silly. You've had a good look at the companies that are being shorted on the market. For people who don't understand shorting, tell us how it actually happens. How is a stock shorted rather than just bought and held?
Yeah, I mean, look, shorting, Peter, is selling something that you don't own. So
and people out there will be saying, how do you do that?
So to sell something you don't own with the idea that you're going to buy it back at a lower price than what you sold it for. So you sell it up here, you buy it back down there, that gives you the profit. So to sell something you don't own, you've still got to make a physical delivery of the stock into the market. So what you do is you borrow that stock, and you borrow that stock from the likes of some of the big superannuation funds who have, billions of dollars worth of equity. Yeah. So they can afford to lend 10 or 20 or $100 million worth of stock. And it's not, they don't lend it unsecured. The borrower puts up cash as security, and at some stage he or she tries to go back and buy the thing they've sold back in the market. With that sold stock, they give it back to the borrower, so they repay the loan.
And the fund manager, the fund manager who allowed them to take the funding gets a small percentage fee as well.
Yeah, the fund manager is getting a little sort of clip on the ticket. In other words, a little bit of the interest, a bit of an over-interest payment. So effectively, the fund manager or the super fund argues that it is actually boosting its members' returns, because if it did nothing, there'd be no return, and so by lending the stock out, it actually gets a higher return for its members. That's the argument. Yeah. The academic research on short selling is pretty clear. It is actually a net positive in the market, it's believed, and that's by and large for two reasons.
You'd expect that from academics, wouldn't you?
Yeah, you'd expect that, but it actually makes the market a bit more stable. So when everyone wants to sell, often it's only the short sellers who are covering positions, and they become the buyers in the market. And often when there's a stampede to buy, the only people who provide the stock are short sellers, because they say this is overpriced. So the argument is that it actually reduces some of the volatility in the market. That's the argument, Peter.
But some people who criticise the super fund managers, they say, well, hang on, if you're allowing them to short stocks that you're holding, isn't that going to drive down the value of the stocks you're holding? And we're members, and
I suppose the counter argument is the short sellers at some stage will buy it back. So if you're, for example, I'm not saying Aussie Super lends out to short sellers. I don't know whether they do or they don't.
I think I do.
But they've got a portfolio of hundreds of billions of dollars, and they might have something like Commonwealth Bank. They might have $200 million or even more just holding Commonwealth Bank stock. So, and they're never going to sell all that out, right? Because they're holding it there because they can't sell it all out simply because they're too big, right? And so for them to go and lend $10 or $20 million with Commonwealth Bank shares, why not lend it out, get a bit of an extra return? The members are going to be better off. The short positions get covered, so over the longer term, it shouldn't have any impact on the share price. It just causes a bit of short-term inconvenience.
Yeah, that's right. And some people are going to know. There is actually a petition going on at the moment to try and ban short selling. Paul, so in the Switzer report on Saturday, one of the interesting tables is the companies that are the most shorted on the market. Now, people who'd read that think, well, these companies must be really on the nose. Tell us about the companies that are being the most shorted, and then answer the question, are they actually on the nose?
Yes, sometimes they're on the nose and sometimes they're not. But look, every company has got some short positions. So what we're really looking for are big positions or material movements, because that's really what stands out as short sellers taking a position in the stock. Now, a company doesn't have to be on the nose, because some types of short selling is just what we might describe as arbitrage or relative short selling. So say, for example, you're looking at, say, the grocery sector, and you think that Woolworths is beating Coles in the sales war. A very valid position would be to, go long Woolworths shares and short sell Coles shares.
Yeah.
Not because you think Coles is necessarily on the nose, but you think Woolworths is going to do it better.
Yeah, and you might think the Coles share price is overpriced, so you're betting that the market will eventually wake up to the fact it's overpriced.
And you're really not taking much market risk, because if the market goes up or down, chances are that both company shares will go up or down. You're really it's just a relative risk of one company versus another. Sometimes it's a sector view. So, for example, the short sellers really don't like a particular industry or sector, and they say, look, that whole sector's, just overpriced. A good example of that is at the moment is the lithium sector. And the short sellers have been fairly right on that. There's a lot of hype about how lithium and lithium batteries and all the work on that was going to create this massive demand for lithium. And of course, what happened? All this new production came on market, and the price of lithium has crashed, right? And the short sellers just took a view and said, all the lithium companies, so much hype, and went short them. And they've been pretty successful. We also had a few years back, Peter, you might remember when we had the Amazon juggernaut was going to come to Australia
and kill JB
Hi-Fi and Harvey Norman and a lot of the other discretionary retailers, and a lot of the short sellers went short the JB Hi-Fis and the Harvey Normans. And what happened is that the companies responded really well, and Amazon was pretty slow in the way it operated in Australia.
So short sellers can be very wrong.
Short sellers can be wrong. So at the moment, they've sort of got I suppose if you look at the data, there's really three themes out there, I think, of the short sellers. First of all, there's a couple of industries they don't like. They don't like lithium, so be wary of any of the lithium miners. They're also not particularly keen on some of the regional banks. So regional banks versus major banks.
Bank of Queensland and Bendigo, whatever.
Is a bit of an issue. There are some stocks in particular that they've got what they describe as, I won't say dog stocks, but they think are going to be just underperformers. Companies like Myer, that's probably no surprise.
AMP?
AMP's got a bit of a short position, but not as much as you might think. Yeah. Another couple of companies that category are companies like Invocare, which has been doing it pretty tough. And there's a few more in that sort of description. So that you've got to look at the data, but there are some big shorts. They've taken a short position of Mesoblast. So we've been talking on Mesoblast.
Yeah, I'll be talking to Julie later about I have talked about Julie.
You'll be talking to Julie about that in terms of what to do there, because the market got all excited. The FDA said no. Short sellers have got involved and said, look, this thing ain't going to happen for a long time, and the market has overhyped Mesoblast. So it's good data to have. You just need to be mindful of.
And it can be a temporary thing. Like you think for the next year, Webjet and all the travel companies, they're going to struggle for a year, so short sell them.
I meant to mention the travel companies. That's the other one. So they're big short positions in Webjet, Flight Centre, corporate travel. And I think that's the short sellers saying that not that these aren't good companies, but maybe the market has already priced in a bit of recovery. Yeah. It's got ahead of itself, and I think there's probably a bit of truth in that, and it's a place to be short.
Yeah, but let me tell you this. It's a really good table to look at, the short selling table, but they can get it wrong, because like Paul and I have been big fans of JB Hi-Fi, and JB Hi-Fi has been on the short sellers, and you couldn't get a better company in this country than JB Hi-Fi, and they've proved them wrong, and Harvey Norman has as well, and every time the short sellers get it wrong, Jerry Harvey, he's very, very happy.
I always say that, Peter, that they're professionals, and as a professional, you try to get things right 55 or 60% of the time, which means by definition you're wrong 40% or 45%. That's about probably what their batting average. But they will get it right more often than wrong, and so it's data that you should look at. So it doesn't necessarily stop me taking a position, but I want to know where the short sellers are doing, because it's just another input in my investment decision making.
Exactly.
And sometimes I might say, look, I've been thinking about Mesoblast, and maybe I won't quite put that money into it. Interesting to see what Julie had to say on that.
Yeah. So that's Paul Rickard. If you want to check out that story, just go to switzerreport.com.au and we'll give you a 21-day free trial if you're not already a subscriber. Thanks for joining us, Paul.
Thanks, Peter.
Before I go, Switzer Financial Group is pleased to bring you the virtual Switzer Investor Strategy Day on Tuesday the 20th and Wednesday the 21st of October. Held virtually via Zoom and hosted by myself, the two-day conference will give investors access and insight from some of Australia's best investors and fund managers. You'll have an opportunity to hear from these top fund managers to understand how they are investing in these unprecedented times. The day will deliver information through idea-driven educational sessions from the fund managers who share insights on how they are investing and what their thoughts are on the future. These sessions will be followed by a roundtable panel discussion. The audience will also have an opportunity to ask questions via Zoom to get a deeper understanding of how these experts are investing. I'm also very pleased to announce that we will also be joined on the day by the Treasurer of Australia, the Honourable Josh Frydenberg. He will be sharing his plans and insights into how he's going to lead us out of this recession. Click on this link in this video description below to register. It's going to be a great day, and I hope you can join us on Tuesday the 20th and Wednesday the 21st of October. See you next week.